Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, John Briggs and Giovanni Zanni. So before getting into today's discussion, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. All right, welcome back, Bondcasters. A pretty quiet week, I would say, since we recorded last week. It was obviously a shortened holiday week in the US and in the UK, and it feels like markets are waiting a little bit for the NFP print in the US on Friday, and of course the ECB meeting next week, which will kick off the kind of 3 weeks of major global central bank meetings. I think the most exciting thing for us in London is that the sun has come back, but let's get into the ECB next week. So we've got Giovanni on today, who's our European economist. So Gio, can you just tell us what we're kind of expecting in terms of our base case from next week's ECB meeting?
Yeah, sure. So the economy outlook has brightened somewhat, but the truth is that we're still in the midst of the pandemic. And so if you look at the level of activity, of employment, we're still below that. Inflation is back to 2% in May. Great, achievement. But the fact is that a lot of that is base effects, and so even more than in the US, by the way. So the situation still requires a lot of support from the ECB. So yes, what we expect next week, I would say that the tone for the meeting was given by President Lagarde at the Lisbon event late last month, when she said, it's too early to ask medium and long-term question. So I think for me, the situation right now is that they are not going to contemplate a slowdown in the PEP purchases pace. The current pace of around 80 billion per month, in addition to the 20 billion of APP, is probably the right kind of neutral level. That will be the level that will bring you to the expected end of the program in March 2022, with exhausting all of the envelope. And if anything, I would say that the ECB will attach to that some kind of dovish bias. We had Schnabel saying a few things about the fact that the reason why the markets have reacted positively in recent weeks is because they are expecting some kind of attention to rates, especially real rates from the ECB. So I guess they will reclaim flexibility. They will not say, significantly higher. They would just say, we'll do what it requires to keep financial condition favorable, but with a qualification that they will particularly be aware of any reaction on rates, and that's it. For the rest, frankly, I don't see any change for the TLTRO, for tiering. That's not the moment to do that.
So you said that Lagarde said it was too early to think about kind of medium-term and long-term questions, but I am going to pitch a slightly longer-term one to you, and that's because, it's all very well thinking about, what they're going to do for the next quarter or even in September, but as we get towards the end of the year, one question that we will be thinking about much more closely is what happens to kind of PEP and APP beyond March. So you talked about the end date of PEP. Do you expect that to kind of end as planned and then APP pick back up, or how are you thinking about the kind of transition of QE through that end date next year?
Yes, I mean, we are, of course, starting to kind of formalize a little bit the numbers to attach to that moment. I mean, we're starting, as I said, at 80 billion plus 20 of APP, and the kind of central scenario I would have right now is to say that the PEP will be decreased by, let's say, 20 to 40 billion, depending on developments, and so the total amount of QE in March 2022, when yes, we think that PEP will expire, let's say, and will be replaced by the more flexible APP, and this will amount to between 60 and 80 billion. So reduction from the current level, but not that much. Also because, again, if you listen to Schnabel, she said this week or late last week that the point is that even when PEP ends, we will still be quite far away, most likely, from the inflation target. And by the way, there is also the strategy review that will come in between this period, between now and March 2022, and that will clearly represent a structural break. So I think that that's quite relevant. So my point is that you will still have a lot of QE in the system, even after PEP. It will not just end abruptly and then we'll have just 20 billion of QE. And by the way, we also think that the kind of continuation of this QE will be long lasting. We put out a note a few days ago, and the central scenario for us is that basically you have a first rate hike around 2025. So it means that between the kind of 60 to 80 billion of March 2022 till early 2025, you will have this decrease to zero of QE, and so it will take almost 2 years to go down to zero.
I just want to pick up quickly, whilst we have you here as our kind of ECB specialist, on what you mentioned about the strategic review, because we know that that's kind of ongoing, coming up soon in the autumn. They've said we think perhaps September. So you think that that is going to be a structural break and be quite important, I guess, for the direction of future policy?
Yes, and actually, again, I'll go back to this speech from Schnabel that I think is quite interesting. She said, even after PEP, we will still be far away from our target of close but below 2%. But the point is that the target will change. Well, the target will change in the meantime, and it will be probably more dovish in a sense in terms of reaction function of the ECB. And we had another important speech, I think, last week from Villeroy, from the central banker, French central banker, and it just gave a lot of indication on how he sees things. Probably it's more dovish than the exact average of the overall council. But he said, well, on the target, a simple target, 2%, which is probably consensus, I would say. The symmetry of the concept. So it should be even clearer that the ECB is ready to accept or even welcome a period of higher inflation above 2% especially after what we've seen, after the mistakes of the past in terms of not reaching the target and of the forecast of always expecting higher inflation that didn't materialize. So I think that that's an important point. We probably will not get to the fate version of that of the US, but it will be definitely more symmetric. And then he mentioned adapting QE towards something that is more like the PEP. So it's a little bit, as I was saying before, this idea that even after PEP is not this is the end. No, we'll have something that probably will be very similar and will continue. And then there are other points. I mean, for example, on forward guidance, this idea, and I think that's also related to fate, this idea that you cannot just count on expectation of inflation, but you will have to be more on actual inflation rates to really raise rates. And that's the idea. That means that we have this central scenario of rates rising in 2025, because that's when we expect to see inflation at 2% in a persistent, consistent manner, robust manner, and with the indication that it might go higher in the following years. And then finally making the TLTRO and the tiering components much more structural again. So again, with this in mind, the March 2022 is not a cliff. It's not the end of the story. And as I said, we continue basically to see a progressive tapering, slowly tapering of QE until 2024 and even early 2025.
I guess that from a markets perspective, that really just reinforces what Giles and I spoke about on this podcast last week around the market pricing in too much from the ECB over the near term, and the kind of rate hike profile that the market is looking for at the moment isn't consistent with what we're expecting in terms of this very gradual rundown of QE over the next kind of 3 to 4 years. Okay, so switching over to the US then, because I guess that's one of the central banks where we've actually seen, albeit a very dovish institution like the ECB, but they've slowly started to creep in a much, well, slightly more hawkish direction. We spoke about Clarida last week, and we've had more Fed speakers this week kind of reinforce that sort of nuanced shift towards a more hawkish direction. Is that right, John?
Yeah, and we've been, as bondcasters know, we've been kind of flagging this subtle shift over a while. And on a global standpoint, if you look at, for example, the global central banks, especially in the Anglo economies, they're all subtly, except for probably the RBA, slowly shifting to a more hawkish direction. And you can say it's going to take a long time. And yeah, we're talking about tapering, talking about tapering, which is going to maybe get announced September and start next year and take 6-9 months. But the point is that when you have a very elongated cycle, there's not going to be a step reaction function for many of these central banks. All of a sudden, they're not going to come out and surprise markets. So even subtle shifts are, important in signaling mechanisms. I mean, for example, it's only the RBNZ, but if you look at their signaling that they might hike rates sometime in 2022, the currency rallied by more than 1% against the dollar, because again, markets need to process this information early because, these subtle shifts take a long time to occur. You could even look at the Bank of England last week when Vliga was a little bit more hawkish. I mean, the speech itself, Ross Walker, our economist, felt it was more balanced. But, again, the fact is that when he was asked about bond markets sending warning signs, is it reflecting an improved outlook? He said it's almost entirely the latter. So, allowing some of these rate rises, just, to some degree, they're not going to allow like Q1, I think, to repeat itself from these levels. But the rhetoric shifting, the idea that yields are higher yields, which we were looking for across these two currencies, are reflecting underlying fundamentals and better growth outlook and better growth outcomes. And then more specifically for the U.S., which is that that we flagged Clarida while he spoke again last week about balanced risks. Fed Governor Quarles, who's the vice chair for supervision, doesn't really give that many economic and inflation outlooks. And even he said that, my optimistic outlook for growth and employment places me among those who see the risk to inflation over the medium term as weighted to the upside. Brainerd, probably the biggest dove. Again, these are really subtle, small changes, but she talked a little bit about balanced risks this week. So this ongoing shift towards, it's just kind of like a little less dovish, or from the Fed's perspective, saying, going from a time when all they cared about was unemployment and broadening the progress to all sorts of demographics, to now actually talking about the inflation side in order to keep their credibility on that front as they move towards tapering and as they move towards higher prints. I mean, Gio said that with the ECB under Fed, is it going to look like outcomes versus just forecasts? The Fed continues to talk about outcomes. Unfortunately, maybe for them, they might be in a situation where if they push that outcome-based methodology too hard, I mean, we have into the fourth quarter and the first quarter of next year, core CPI and core PCE inflation prints over 3%, 3.5%. So they got to be careful kind of like getting what they wish for, because if they get too much of that too soon, then the market might challenge it. But I think this rhetoric also is a tool for them to say, look, we know we want a little bit of inflation. If we get it, that's fine. We know how to respond. We still are paying attention to our inflation mandate, but we are going to let it run hot still. So trying to thread that needle between, keeping credibility on, not letting inflation let loose with trying to get higher inflation outcomes. So they almost have to be hawkish in order to get their flexible average inflation targeting to succeed. And I shouldn't say hawkish, they have to flag inflation risks and that they're watchful of them and they're keeping an eye on them. And that's one of the reasons why, over the medium term here, as we head into the summer and as this rhetoric's changing, we think that creates a little bit of an asymmetric risk to the upside, because we do see higher inflation prints, whether you want to argue it's transitory or supply chain issues or not, we do see them in the next few months. So we need to, the Fed is going to need to keep talking in that manner.
So coming back to the little bit more near term rather than looking over the medium term, I think one thing that everybody in the market is very focused on, and I'm sure Fed officials will be watching very closely as well, is of course the NFP print on Friday. I should just clarify, we're recording this on Wednesday. You might be listening after Friday, so you might have the luxury of already knowing the print, but we obviously don't. So could you just kind of talk us through what we're expecting there and what that might mean in terms of the policy reaction for the Fed? You know, what kind of a number might change the rhetoric that we've been seeing lately, or even what kind of a number might just really justify this slightly hawkish shift that we've been seeing?
You're really trapping me because you're getting me to talk about a payroll print that the listeners are going to have, and I don't.
Right.
So no, I think that, I mean, our view, and listeners will be able to tell if I'm right or wrong right here, but is that the number creates a little bit of, again, asymmetric risk to upside in yields. And again, not massive, but if it's another small number or lower than consensus, I think the market's prepared now to view it as labor market supply issues. It's very much kind of giving the labor market a pass, because this could last a few months. If it's about childcare, well, schools and camps aren't fully up, but schools are going to reopen in September, so that might be an issue. Fears of COVID, we still see, even in places where mask mandates have been dropped, mixed results. There's still some anxiety out there. There's still, vulnerable populations. So worries about, COVID still remain. And, the unemployment benefits are providing motivation. I mean, I like to think of it as, if consider you're, a restaurant worker who needs to deal with childcare, but is also getting extended unemployment benefits. Do you want to go back, be basically on the front line for minimum wage or less plus tips? That's a hard call to make. So I think these things could last a while. So if it's weak, you can excuse it out. If it is really strong, you can say, oh, wow, here we go again. And the bigger thing, I think, is that a week or two from, next week is you get CPI report. So that CPI report, after the last strong number, I think is going to create, some angst. I don't know what the number is going to be. Like I said, we have firmer prints, but there's so much chop in the data. I think to, have any confidence in forecasting things is really difficult, right? Or stretch right now, I should say. But if you have a decent employment report, the market could see some pressure into the CPI on fear, and then we'll see what it is. And then you have the Fed after that. So there are combinations of data where it could just be completely choppy and noisy. And that's fine. We trade sideways. I have a hard time coming up with a lot of outcomes that have yields at these levels fall that we take more Fed out. But if you get a combination of strong prints, there could be some worries about signaling at the June meeting, especially as it's a dot meeting, it's a forecast meeting, and the Fed might need to raise some of their forecasts. And given the inflation comments that we've gotten, from governors, maybe they start to take those inflation forecasts up a little bit too. So it feels like it could be a little bit of a hawkish month. It might not, but the balance of risks point towards that direction in my mind rather than the other one.
So very good. Well, the balance of risks, and I guess point in favor of our short 5-year Treasuries call. So I guess just to conclude, I can imagine that you're sticking with that call for now then.
Yeah, and we recognize that it could be something that takes a little time to evolve. Leveraged investors, it is a negative carry thing, so it has to be tricky to time. So we think this is a window where it's worth trying to do that carry given everything I went through, but recognizing that if you get a data set, it's not worth it. But from a real money perspective, trying to just balance your portfolios where this is the part of the curve, we're in that part of the cycle, which you should try to avoid. And it makes me a little bit more comfortable in flatteners like 5 cents, 530s, because the Fed is reaffirming their credibility on the inflation side. If we were having these in higher inflation prints and they were just not talking about it, only talking about unemployment, and that's fine. We want huge inflation. We want, that would have me a little bit more worried about one of those reflation type trades, bear steepeners like we had in the first quarter. So the rhetoric's important. It also makes me feel like that we are going to be in that traditional type of cycle where you bear steepen first on expectations of higher growth and inflation. And as those get validated, the pressure moves in the curve as we start to price in more hikes. I'm not crazy bearish. I don't think 5 years are going 1.5%, anytime soon. They're at 80 basis points now. But I think that's where the pressure will come along the curve. And so portfolios should just be cognizant of that.
Okay. That makes sense. Well, thank you both for joining me this week. I'm sure this kind of topic of central banks is something that we will be returning to a lot over the next few weeks, because like I said, we're now entering that kind of 3-week cycle of the ECB, the Fed, and the Bank of England. So we will touch base again next week after the ECB. And just a reminder to everyone listening that if you liked today's episode, please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. Thanks again. See you next week.